Before we get into the episode, a quick reminder that this podcast is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Now for a word from OnRamp. OnRamp is a Bitcoin asset management platform built on multi-institution custody. Leveraging our partnerships with industry veterans BitGo and CoinCover, OnRamp's multi-institution custody is a segregated vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. Our industry-leading best-in-class approach to custody helps individuals and institutions secure new and existing Bitcoin positions. All keys are held in deep cold storage and kept 100% offline, managed with institutional-grade security best practices. The custody solution eliminates single points of failure and reduces counterparty risks, ensuring maximum security and peace of mind. OnRamp's suite of products includes our custody offering, a spot Bitcoin fund, private wealth services and inheritance planning, and managed wealth for advisors. Whether you're new to Bitcoin or a veteran in the space, we would love to connect with you to understand your needs and how we can serve you. Please visit our website at onrampbitcoin.com, where you can schedule a consultation and connect directly with our team.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Woo-hoo-hoo-hoo. Welcome back to the last trade, first of 2024. We're recording on Thursday, January 4th, 2024. We're joined by Matt Dines from Build Asset Management. With that being said, we're going to have a new format to the show. A little more structure. What do you guys think about a little bit more structure? Is that good?
2024, new year, new us.
New year, new pod.
It's not the last trade. It was the last trade of the year. I think we might have confused some individuals in the last year.
This is the TLT to be bullish on.
Ooh. Matt coming in and providing the pod with a meme to start the year. This is the TLT you want exposure to.
Matt, if you go to tltbtc.com, it will redirect you to our the last trade.
That's awesome.
Great domain. With that being said, new structure of the show is we're to come prepared with a few topics to discuss before we get into the main topic. The main topic of the day, sure, won't be surprising, will be the ETF approval or further delay is imminent within the next 5 to 8 days, I believe. So a lot of people are waiting with bated breath to see what the SEC does. But before we jump into the ETF, we're going to start with the topic of AI and its impact on the broader economy. Obviously, 2023 was the year of AI proliferation. I believe it was October or November of 2022 when ChatGPT launched and essentially provided the economy with the first consumer app in the artificial intelligence world that reached mainstream success. 2023 throughout the year, we had an explosion of people using the products, people creating companies around artificial intelligence, and companies trying to determine whether or not they should implement it, or more likely how they're going to implement it into their stack. And then I think a really important topic that's on top of everybody's mind as it pertains to artificial intelligence is its effect on the broader economy, particularly the jobs market. So let's just start with the huge excitement within Tech Chart, Logan. And this is a pretty astonishing chart, especially when you compare it to the iPhone and the Apple App Store. On the iPhone, which was considered to be probably the biggest tech innovation and disruptor of the first 20 years of the century. And if you look at this chart, you can see that AI using Hacker News Trends is exploding above the iPhone levels that hit in 2008, 2009. Now we must say, obviously 2023, there's probably a lot more people on Hacker News, but still, this chart is a bit bit astonishing. So Jesse, I'll throw it to you. What are your high-level thoughts on AI as a trend, what happened in 2023, and what we can expect in 2024?
Yeah, it's such a huge topic. When AI finally came out, with products that people can use to implement into their daily work and their businesses, ChatGPT. My instinct was, okay, this is going to be like a classic Gartner tech hype cycle progression where, and for people who aren't familiar with that, it's the idea that when something is brand new, there's a ton of hype about it. And then the hype can't live up to where the actual development of that tech is. And so you enter this lull, the trough of disillusionment, where it feels like it never delivered, that technology just never materialized as something real that mattered. But meanwhile, real progress is being made with making that technology better and integrating it into the economy. And then eventually the impact of that technology is greater than the original hype expectation was in the first place. But you go through that trough. And so that's what happens with every technology. And so, for the last year, I've been assuming that's what will happen with consumer grade AI here. And I still think that that's probably happening, but I have to admit that I think maybe it's just like that this version of AI is so immediately useful to anybody doing a job that it has impacted productivity already to a degree that I didn't think would be possible within a year. And I still have some doubts, and I'm very curious to get Matt's thoughts on this about how much of the sort of stock market rally is actually because of like productivity and the economy doing well versus liquidity and having to print more debt, which the U.S. has been doing the last 9 months in particular, which ends up adding liquidity to markets and things rally as a result. So I'm not really sure what's happening here, but I have to admit that that AI has been having a greater impact, and we've been seeing it at OnRamp. I mean, there are AI tools that we use on a day-to-day basis to help us be more efficient, and I'm sure that's happening in every company right now.
Yeah, Matt, I know you and what you guys are doing at Build is really finance focused, credit market focused. What are your thoughts on this? Have you been dabbling with it at all? Is it something outside your purview?
So for using the tools themselves directly, I mean, it's a huge assist for, I'd say that second step in writing, Marty, as a writer yourself, cranking out content every day. The way I approach it is the first step is, have your outline, but then the next step is just kind of filling in the body, so putting the meat onto the skeleton, if you will. And I think just from that element, it's massive for people sitting in my seat, where a big portion of our job is just to communicate externally. So it's a huge help there. But I think to talk about the rally over 2023, right? Coming out of 2022, if you remember, end of Q3, there was we markets kind of ran into the global constraint of how fast rates could rise. And eventually you found out who the weakest link was. Well, it turns out it was the UK pension system. And that's where we really had the first liquidity driven rally, I would say, as Bank of England stepped in with, what we call maybe like a not QE, if you will, just a couple weeks of just patching up the system, offering to not go fully ahead with the QT plans, give them 3-4 weeks delay for these pensions to move around money and get their get their, they had to sell something in their books, but a lot of these instruments they were selling, private credit, stuff like that, that's illiquid, that doesn't have a bid. You get that moved and shuffle the shares, and that created a rally where the pressure in dollar markets eased. FX, DXY, after that massive run up in 2022, just kind of the pressure let out, and at the same time you saw energy markets roll over, for the first time. They did it again recently. Same thing, the September effect with the Q3, and you saw it again this year. But last year was, I'd say, the big one, and that really created the rally going. As energy comes down, dollar, a lot of the capital and the global dollar financial system is actually deployed into these shipping containers. Fill up a tanker with crude or something like that. Like, it takes a lot of dollar capital as all of those vessels are in transit globally. So as oil really sold off, and the dollar pressure eased, those two things created that first run of liquidity. And then last year, if you're thinking about these first 3 days in the year of trading that we're in now, last year, as opposed to this year, we got out of the gate where kind of equities are stumbling a little bit. Last year it was the exact opposite. It was just a really strong rally to start the year, and then from there it was just kind of just momentum kind of gathering throughout the year. You had that first liquidity squeeze in March that came in with the banking issues, but once this kind of the financial system realized that was not the actual credit crisis, if you will, that would mark the bottom tick of a dollar credit cycle, it was just kind of, again, full steam ahead, liquidity driven rally. So I think these two things were playing into each other. To go back to the question, the AI was, or is, if you think about like the bleeding edge of tech in the economy, it's always the leader. Like whether it's the railroad era in the late 1800s or autos in the early 1900s, radio in 1930, to PCs in the semiconductor in the 80s, 90s, et cetera, to the bleeding edge right now is it looks like, from the technology standpoint, it's AI at this point. So those two things, like the dollar credit system and then the real deal, these tools are real. They are going to impact productivity in the economy. They're going to have a massive downstream impact. But I'd say it's both of these things, playing off of each other right now.
Yeah, totally.
Yeah.
Michael?
Yeah, I think, Marty, you've been playing around with a lot of these tools, and I think you kind of fall or seen in the camp of like how transformative this stuff will be or can be. And I had this like unlock the other day. That chart, we'll put in the show notes. It came from Benedict Evans. I think he was a former partner at A16Z, but he puts out a year in review. And I think this one was solely focused on AI. And I think what he referenced is last year, it was a lot of like what AI can do. So it was like basically describing or prescribing like, oh, you can do it for, management consulting tasks, like various tasks that you saw in the market. This year, it was like, oh shit, like this thing is much bigger. It was, what are the questions? And this core question that he put was, is it the next platform shift, similar to like AWS coming from mainframes, or like the iPhone? And when you got an iPhone, you grabbed it and you didn't really know everything it could do, but it was transformative. And it took out like, your flashlight and all these other things. And then years later, you start having Uber with geolocation and the other things associated with it. And we still probably don't know all the things that it will be able to do. Or does it change the nature of software and like how you interact with it when it comes to coding and the, things you hear about, and how they start to like daisy chain together and you really being able to just dream up ideas. But then the last part is like, does it take us to AGI? And it's like this idea of what does that mean? And the funny part is I've like looked into this and I could be wrong, but most people don't actually know how this stuff works. Like from the neural networks and the large language models, like as the weights start getting calibrated and more data coming through, they don't actually know how far it can go. And the long of it is like, as I started looking, it's like, oh my God, it will change everything. And it will change everything in the same way that Bitcoin will change everything. And they actually will find a symbiosis with each other, because they have to, if you think about like when things change, the incumbents usually don't adopt it because it changes their fundamental business model. So it's generally net new entrants that come in. And so when you have that, you basically are going to have net new people coming in. And if it's AI, you're going to need business models around it that accept a borderless or permissionless form of money. Because if it's a weird model that's happening and you don't want it to be used, you're like, well, I'm not going to let you use your ACH or Visa or whatever it is. In the same way, so like the core idea is like they will naturally grow with each other. And I guess where this ties into Bitcoin is you'll need Bitcoin to pay for it, but then also thinking about like the model when we think about multi-institution custody or these other primitives where they're Bitcoin native, they generally are antithetical to the financial system as it exists because of like the centralization of assets and how you want to hold custody and then, build products around it. And it's a similar thing where, these models that are primitive to Bitcoin will generally be built by net new entrants, not the incumbents, because it's so fundamentally transformative or disruptive to their existing businesses. So I don't know if that like fully crossed, but it's like this idea that both sides are so big and transformative that it will be new entrants that majority, it's an overgeneralization, but 90% come from new business models and new, looking at what existed, but then building it at a more efficient, better rate than somebody adopting it and then plugging it into their system.
Yeah, I think one thing you said there in particular is very high signal, which is most people really don't understand how these large language models work in the first place. And actually, Alex Svetsky from the Bitcoin Times has been releasing a series of articles on TFTC this week talking about exactly this problem. And so building a large language model is not easy. And like you mentioned, the weights and the data you're feeding it and how you're feeding that data are very particular if you want a particular outcome. And I think that will be the big trend of 2024 is people really learning how to actually build an LLM appropriately for the end use case they're looking to serve. And then on top of that, like AGI, I actually had a long discussion with Alex on TFTC about this. He's pretty convinced, and he makes a pretty convincing argument that it's just a red herring, like artificial general intelligence. When you actually understand how these large language models operate, they're essentially making probabilistic guesses at certain outcomes. They don't really have true intelligence at the end of the day. His thesis is that AGI, artificial general intelligence, is a red herring boogeyman that the incumbents can use as a means to create a regulatory moat. And at the end of the day, their large language models will achieve quote unquote AGI as they define it. But at the end of the day, it's not really general intelligence. It's could be used as a ways to proliferate propaganda, because you're basically getting answers from a model that was designed and created in a very particular way. And so that's another big trend I'm looking forward to in 2024 is the proliferation of more open source LLMs to compete with the open AIs and the Anthropics of the world. And I think that will actually open up the market for these tools. And I do think in regards to what you're saying about the convergence of Bitcoin and AI, that is where Bitcoin will shine most acutely, is because these open source models are going to have to be able to monetize. And I think that's the biggest problem with these open source models right now is like accessibility. Who's going to run them? Who's going to run the GPUs? Who's going to give people access to these models, and how are they going to monetize? And I think Bitcoin, particularly Lightning Network enabled paywalls, makes it very easy to monetize those. And you mentioned privacy. Bitcoin, if you're a company looking to maintain some semblance of privacy while you're using these tools that are being hosted by third parties, instead of having to set up an account with your name, your address, your company name, and your bank account information, or your Stripe information, a simple Lightning enabled paywall really cuts out all that. It's like, all right, you give me the money, I give you the result. I don't need any more of your information. So that's a big theme to look forward to. And then in terms of where we are in the hype cycle, I do think we are still in a bit of a hype cycle. I think 2023 brought with it insane valuations for AI companies. Anybody in Silicon Valley who left a big tech firm to start an AI company got funded with insane valuations out of the gate. And I find it hard to believe that most of those companies are going to be able to provide the value to their equity holders that actually justifies those valuations. And so I do think that's where we are in the hype cycle, where people were just able to slap AI on a business plan and get a lot of money and crazy valuations. I think there will be a massive correction there over the next few years. And then as it pertains to actually using the tools, I do think there is a lot of signal. And like you mentioned, Michael, we've been using it a lot at TFTC as a means to accelerate the amount of content that we can put on our site. And I've been very public about this. I'll talk about it here as well. But we've been using ChatGPT and Assembly AI. So ChatGPT, obviously, everybody knows, is the chatbot provided by OpenAI, and then Assembly AI is a transcription AI service. And so the problem I was having trying to use ChatGPT to help us put content on the site is that it would hallucinate a lot. You'd give it a prompt and say, hey, I need help writing an article about what a Bitcoin UTXO is. And ChatGPT would just go scrape the web and go to a bunch of different sources and then give me something that was completely incoherent. And I'd have to spend over an hour editing, and it really wasn't worth the time. But now with the combination of Assembly and ChatGPT via a tool called parseprompt.ai, which was founded by a friend who reached out to me. He's like, hey, I have this tool. I think it could work for you. What we do is we now take audio content, whether that's podcasts, YouTube videos, predominantly podcasts and YouTube videos. We feed them into Assembly AI. It gets a transcript of that audio file. And then you tell ChatGPT, I need you to write me an article specifically on this content. And the hallucination essentially goes to zero. And so you can actually get good, valuable content in written form that I can then put on the site. And so this is an effort to accelerate what we're trying to do at TFTC, which is curate what we deem to be high signal content in the realms of Bitcoin, economics, culture, finance, health, all that stuff. And we've been able to accelerate me, a one-man team, writing one article a day, to anywhere from like 8 to 15 articles a day, just using this tool. We're creating a process around it. And so there's definitely signal there when you utilize the tools the right way. So I think that's another thing that will materialize in 2024 is people getting more familiar with this and getting smarter on how to combine and utilize these tools to get the correct outcome that actually provides a more productive business at the end of the day. And it certainly worked for us at TFTC. Those are two tools that we use, and then the other is Midjourney to create images for the thumbnails. And I've gotten really good at prompting, which has been a fun learning experience over the last year. But I do think there's definitely signal. There's definitely a lot of use cases, and there's definitely a lot of noise too. And so I think 2024, we're going to begin sifting the signal from the noise and the trends, people getting smarter on how to build LLMs, open source competing with closed source AI. That is actually one of my goals in Q1 of 2024 is to transition away from ChatGPT and Midjourney to more open source models, because I think they're actually reaching parity with these closed source models. And I do think the trend, if it continues, will have open source models being better than the closed source models. So that's one thing I'm looking to do rather quickly here in 2024. And then that begs the question, what is the effect on the jobs market? And that brings up the headline from Google, which is in 2024, due to their utilization of AI, they expect to lay off 30,000 employees.
Yeah.
That's massive. Yeah.
I mean, you mentioned it just for yourself, right? Like how deflationary. Imagine how many people you'd have to hire to run what you do. And Jesse mentioned some of the stuff we're working on, and like the sheer number of like from an efficiency perspective. But you teed in on a key concept, Marty, about the open source and the models. You can imagine a world where like it's every day you kind of look at Twitter and somebody posts about like ChatGPT or one of them being like to whatever the angle or ideology or political side is, it's like it's skewed in a certain direction. So you can't even like be confident the information you're getting. So the open source nature is important, but then you kind of dovetails into, well, how do you pay for that? And that's where like an operation choke point, this stuff all exists where then, well, can you pay with your Visa? Can you pay with your credit card? Can you do that? And that goes back to the disruptive nature of these technologies. And then when you start to play with the incumbents, they kind of are able to say, hey, like, maybe we just can't accept your visa because you're providing some of these like API feeds that are giving information that we don't think is good, or for whatever reason. And that's why that symbiosis with like Bitcoin and AI is like a natural fit, because you need a borderless, permissionless form of currency that's also digitally native, right? For obviously artificial intelligence, but that's where it just feels like natural to like tie in together, which is also applicable for this whole pod of like where this is all going.
Yeah, and that's. Sorry, Jesse. Take a lot of time.
It's so interesting to hear. I mean, Marty's at the forefront of practitioner use of AI and deploying that. A lot of things in there that I found very interesting, and I guess first and foremost is Svetsky's position that it's a red herring and AGI isn't really possible, and I agree with that. That reflex to be wary of how this ends up being used politically, because that's certainly going to happen. But then my neuroscience background, my undergrad was in neuroscience, has me pretty convinced that the brain is just a machine, just a series of switches. And, that becomes a philosophical debate of like, do you believe that the soul is separate from the brain, or do you think that the soul is the unconscious product of this machine, this very real machine, just a series of switches? And I believe the latter. So if you believe that, then it's possible to create a brain, basically, and it's possible to create consciousness. The
soul is the promptee. The soul is the prompter, right? It's prompting the brain to do things.
So anyway, that I am deeply in that camp as a result of studying that stuff from a biological point of view, and it's all just synapses and conditioning,
neurotransmitters, and
yeah. Anyway, so that's all very interesting to me, but at the same time, maybe that's the hype cycle in a way too. I agree with your point about valuations being too high potentially to deliver real economic value, and that might be a part of what's happening right now. That we're kind of at that Gartner tech hype cycle peak before the trough of disillusionment in terms of the economics of this technology. But it could also be that people are going to be disillusioned that, oh, you know what, it seems like this technology just hallucinates all the time and doesn't have any kind of consistent consciousness that emerges, and so AGI is not possible. Meanwhile, like the technology could just continue getting better and better, and these models turning into full brains, basically, and then you have AGI emerge several years from now. And it's all fascinating to me because I was most interested in this stuff about 10 years ago. The book Superintelligence by Nick Bostrom was kind of mind-blowing for me back then. And it predicted all of this. It predicted it sort of dovetails with the singularity is near hypothesis of, as you have this exponential growth of technology, and Moore's law continues, where does that lead to? It eventually leads to a point where computers become more intelligent than humans, and then computers become capable of making better computers. And then that really creates the exponential, a singularity moment where beyond that you can't predict what the world is like, because suddenly progress is taken over by computers instead of humans. And so that's the whole idea of the singularity, and that's what these tech luminaries for the last 20 years have been pointing towards. And part of the predictions that were in place at least 10 years ago were like this slow progression of artificial intelligence in niche categories, and then those niche categories broadening until eventually it's AGI, and then you sort of reach a singularity point. And it's weird that we're like, it's playing out. I mean, I don't know if it's exactly on the timetable that was predicted 10, 20 years ago, but it sure is playing out in terms of how it feels. The world just feels to be changing at a faster and faster rate as tech software eats the world. And so I don't know. I agree that 2024 will be all about refining and improving on this stuff, and a whole lot can happen in 1 year. And so we might find a greater degree of change over the next 12 months than we saw over the prior 12 months.
Yeah, it's going to be
I
pretty
would,
insane.
go ahead.
Go ahead,
I was
Matt.
going to say I'd second that. I think what you guys raised that point about the regulatory moat, right? So far the narrative we've heard mainly in the op-ed pages about kind of reining in, regulating this technology. It's been about the left tail risk, right? The Skynet scenario, Terminator. He gets a hold of the nukes, and oh my God, that's the existential risk to humanity. But I think there's something even bigger when you like listen to Marty's story about what he's doing with TFTC. Like his use of these models is basically like having another teammate, right? And you could think about that as they get more and more specialized. It's like one model is hyper trained for one task, and then that impacts organizations. Like so, instead of like the post-industrial era, like the post World War II era of how corporations and businesses designed out their hierarchies, right? I mean, it's just like a tree where maybe each individual in the tree has 6 direct reports mapping up to them, and then down to the bottom of the node where you look at the org chart, it might look like something like a Christmas tree in terms of the organization structure. But as you go through this is like this AI, and this begins to really integrate into the rest of the economy. Like this is gonna play in like to all of our social structures, the existing kind of financial position of organizations, as well as the public sector, which we can get into later. I mean, it's well known that there's serious problems there, and also I think you think about the dog not barking right now that everybody's kind of aware of is what's going on in commercial real estate, right? There's a lot of skyscrapers out there that are just impaired properties. But I think what it boils down to is like our social. This is going to change our organization structure. Marty mentions what he's doing at TFTC. Compare and contrast that to what the version of TFTC looked like in like the 60s and 70s. I'd say it'd be like the Rolling Stone magazine would be a good comp. Like it's an operation, media entity that tried to capture the cultural zeitgeist of all these big things that were happening in the 60s, 70s, and all of that. And I think that's what TFTC has its finger on the pulse for, right now in this era. But now instead of, a massive media operation with hundreds of employees, sending these writers all over the world to get the story, Marty has himself, and I don't know how many employees you have, but it's not hundreds. It's more like 1, maybe 2, and then you can get all this other work done. And so you're doing the same thing with, just a much lower footprint, right? And that trickles into like everything indirectly. If you think about it, like it's office space. Like now we don't need to fill up, a floor in Manhattan with an office for Rolling Stone. Now it's Marty and TFTC and, one room off the Commons, the Bitcoin Commons down in Austin, and everything that kind of trickles down through that. But then it's also like the knowledge worker, right? That's been the base of the this big boom in the kind of the post 1980 world, as the boomers kind of fully entered the workforce in the 70s, and then as they really hit their stride in the 80s, the primary beneficiary of that was like this knowledge worker, right? And a lot of these tasks weren't really high brain activities that a lot of these people were doing. Like a lot of it is just operational paper pushing that is going to be the lowest hanging fruit for not just the AI. Like the semiconductor and the internet have already eaten a lot of the easiest jobs kind of to automate and manage. But now we're going to move up into like the middle market and maybe front office part of the stack in terms of like the financial industry footprint. So then when you take it to that level, you're like, all right, that's going to make this office CRE problem materialize, as it already is, and then that's going to impact the banks and the financial sector. It's also going to impact the fiscal position as you think about like that taxpayer, right? This AI, it's basically a quasi teammate. It's your new direct report, right? As one individual, one human takes advantage of these tools and can hyper specialize. That those what we call them like synthetic workers, they don't need benefits, they don't need a 401k. They don't need health insurance, and they don't, there's no good way to tax. There's no W-2. So the real tail risk, like, yeah, sure, maybe they get a hold of Skynet and we all blow up, but I think it's even more in front of us. Like all of this, the faster this integration happens, these organizations and existing kind of social structures from the bottom to the top, like at every scale in society, are going to have to absorb this. And it's just going to be one of these periods, it looks like, where there's a massive amount of change, not just in as Jesse was mentioning, like the singularity is near. The technology is going to get better and better, right? We have tools that can make better tools now, but then the speed and the pace that our existing systems have to adopt to this massive change, like it is, the way I see it, it's the only way I see it is escalating. Like it's going to become more and more front and center. So that left tail risk of the nukes firing, I don't know that that's the biggest thing to worry about right now. It's the eye on the ball. It's like, how do we, all of our institutions, like what would be keeping me up at night if I were a policymaker in Washington, D.C. is how do I keep society in line and maintain some sense of organization as this massive kind of phase shift takes place.
Yeah, we're entering it's a massive acceleration of technology deflation, right? And what Booth always writes about, and Matt, to your point, like we're going to see the reemergence of UBI as some necessary political agenda, because there's going to be a lot more people out of work because AI has taken their job, and how do we support these people? We need UBI, and we need to print money to help retain society as we know it. And so that's going to come roaring back. And overall, like you touched on something that I hadn't really thought about before, but AI is really going to cause the shift away from the knowledge economy that we've known that the boomer world was based on. And Bitcoin is a big part of this story, because I think it shifts from a knowledge economy back to a capital economy, where it's going to be all about like how do you deploy capital to create a product and good by leveraging AI. And so Bitcoin becomes the foundation of a new like capital-based economy after this transition period that we've had over the last century, really, of a knowledge-based economy.
Hard skills and hard money are the next decade.
I mean, just to put some numbers on all this, Matt, while you're speaking, I went to my assembly, OpenAI, and parse prompt cost. It's cost me $250 over the last month and a half to create more than 100 articles, where if I had to pay staff to do that, it would have been thousands of dollars easily.
So we probably need our own, we need to do a AI dedicated, or themed TLT. But one thing that's like to play this, or what you mentioned about like singularity, it's like, there's this natural thing that you're doing, Marty, that I think is really important. And it's kind of like tricked myself into this new pod with Final Settlement, is getting ahead, because we've been so busy working here. And I fundamentally believe that like, unless you kind of adopt these tools, you just start to move. It's just like Bitcoin. You start to move behind like in the world, because it's so crazy and transformative. And that we look at the deflationary nature of it and the layoffs and all of the stuff. It's like, if you want to keep pace, is like getting ahead of understanding the tools, how they impact you. And then I think like for a while, right, it doesn't naturally transition to just no humans are involved in a lot of these tasks. It's just you're augmenting your personal skill set coupled with these tools. And that's how you kind of like make the cliff of like who's still around and who's not. I think is an important function, or like kind of takeaway from a lot of this, is it's not all like doom and gloom. It's like, obviously this is just a natural part of like deflationary aspects of technology, but there's an important aspect of just like starting to look into it, because there's a lot of ways to play it where you can benefit.
Yeah, and I guess that's the big question. I mean, anchoring back to the Google headline of their plans to lay off 30,000 employees this year because of how AI is affecting their business, I think that's the big question that is out there. Does this lead to like a hyper-deflationary event that has a fallout of the job market, or do these tools incite something where you have like 1,000 roses bloom? Like, are these people get laid off going to recognize that they got laid off because of the AI tools and view that as an opportunity to go start their own AI company, or start their own business, maybe not even directly related to AI, but knowing how to leverage AI, which I hope any Google employee would know how to do to go start their own business. I think that's another big question that will begin to get answered in 2024. Is this something that's an existential crisis to the job market, or are we Luddites and this actually turns out to be something that is making many more people extremely productive and able to go feed themselves because they can leverage these tools?
I think it's an ebb and flow kind of thing. If you worked at Google, there's not a lot of places somebody after they get laid off from Google can go and do. Their brain hasn't worked for a while. There's 200,000. I mean, it's just a fact. Like you go, the golden handcuffs are a real thing when these firms hire people so they don't go out to compete, or they sit and roll and do the performance review. Obviously that's just a generalization, but it's a reality for a large portion of just in general, companies.
I think too, there's an element where, I mean, it's if you get out in the field, and you go experience trying to, go stay at a hotel right now or stay at a resort, whatever, or go to dinner with your family. There's it's pretty clear, a shortage of employable workers at what we call blue collar jobs, right? Like the low value add jobs, traditionally over the last 40 years that you didn't need a college degree for, of a class, an economic class that's fallen behind, right, over this massive bull market in financial assets. There's a shortage now of that type of worker, versus, where the economy's kind of shedding jobs at the white collar sectors of the economy. So there's something massive going on where, this big shift in where society is allocating its resources, including our human resources, right, is going to need to take place, because there's just, it's pretty obvious now. There's all these impaired office skyscrapers across the metros in the U.S. And I don't know of too many markets where it isn't an actual problem. Is telling you, it's giving signal that there's something even bigger that needs to take place in terms of where our society has misallocated resources. And that goes down to where we've trained up workers, where the college degrees have been, what people have been majoring in, and where people have been, kind of funneled into for economic opportunity, as the Luke Groman type of thesis says, we don't have enough, plumbers, electricians, home build, et cetera. And there's just going to be a massive shift that looks like it needs to take place.
And it hasn't been possible. It hasn't been possible to make a life as a hotel worker and provide for your family, because of the last 40 years of bull market and financial assets and how that has impacted the price of everything. But that becomes what Bitcoin makes possible again, of you can live a blue collar life of saving Bitcoin and seeing your purchasing power grow over time, because you have a good money, and you don't need to go to college to chase a high paying job, which has been really the only viable strategy, or has emerged as the consensus only viable strategy over the last 40 years in particular. But I think that trend, that kind of wisdom only percolates in hindsight. After there's literally a generation's worth of economic data that then people from parents pass down to their children of here's what worked for my generation. That's what I wish I had done, basically. And so I think 20 years from now we'll get people saying, you know what, just accumulate Bitcoin and forget about college and be a plumber. And maybe that's, it doesn't all start in 20 years, but we'll have a slow transition back to that being a prudent bit of advice to give to the next generation. And that all makes it possible to restore what has been a gutted blue collar class. So hopefully the blue collar workers find Bitcoin and incorporated it into their financial planning, because that makes it possible to be a blue collar worker and thrive. So I'm hopeful, but we have to reach them with education too.
Yeah. The romantic in me likes to think that this will enable people to focus on more virtuous endeavors, like building beautiful things, beautiful sculptures. Like over break between the last two recordings, I was home. I flew into Philly from Austin and got dropped off at 30th Street Station in Philadelphia to head up to New York for a pub key event that I was co-hosting. And just sitting there, I had to wait for like 45 minutes in 30th Street Station. And if you've never been to 30th Street Station in Philadelphia, I highly recommend you take the trip, if not only.
When was it built, Marty?
When was 30th Street Station built?
It has to be a turn of the century, like Beaux-Arts or Art Nouveau or maybe Art Deco kind of building, right? Back
1933.
Yep. Okay. So Art Deco.
Yeah.
Probably.
It's a beautiful piece of architecture. Hopefully we can get back to that with this. I think that we have to find a silver lining in this. The white collar workers are certainly about to see a mass extinction, if you will. It seems brash, but if having used the tools myself, like it's happening. There's nothing we can do about it. You can be a Luddite and try to dig your feet in the ground and tell the government to slow things down, but it's not going to happen. We're going to have to get back to building beautiful things, and I do think this will shift people away from the software world towards the physical world, which I don't think is necessarily a bad thing. There will just be
if you really think about it, it's a practical, obvious thing. Like if you look at it like a pie, and like if everybody's here in the white collar, and then you have all these tasks and things that need to be built, and historically for hundreds and thousands of years, we've had this filter. Like we've just outstretched that via like money and all the things we know, that you have to start going back to like people have to build things. You have to deliver services in the real world. It's a, it actually shouldn't be that kind of like crazy that we say this, or like the market is like starting to change. It's like we all have to get into the circles of our competence and like what the market needs.
Yeah. And that's because the money and investing in general has made it so that you can't aim for anything but the top 10% of jobs. Like there's no way to thrive. It's hard to thrive.
A funny example that's just relevant here is the two smartest, for sure. The other one I haven't worked with, but talked to more mechanical that I worked in my limited career, call it 15 years, and we're mechanical engineers that had to go into like TradFi because it just didn't pay. And that was what society told them. One was from India. The other one went to Carnegie Mellon. And they were the smartest people I ever met. They didn't even want to be doing what they were required to do. And they were the best at what they did. They wanted to be out like working with like kind of like prints and all the things associated with it. But they were there like working with numbers. And that's because of what Jesse just related to. And there's so many people like that all over the job sector globally that are just forced into these functions that they weren't based to, like Marty's point. It's not even necessarily romanticism. It's just a reality that people build things when they're not worried, like beautiful things, when they're not worried about like being able to, live paycheck to paycheck. And if all the things associated with come with like a bad form of money. So this is definitely going to happen. It's just going to take time.
Yeah. I mean,
there's nothing. Oh, go ahead on that one. Go ahead,
I was going to say, just to piggyback on that, Michael, the chief investment officer of the fund I worked for out of college and worked under, was a Russian cosmonaut and immigrated to the U.S. to write algos for like hedge fund indexes and stuff like that.
It's the joke about Google.
I mean, we've kind of experienced this as in the 90s, all of the PhDs, the quants kind of like got pulled in by Wall Street, to create new exotic derivatives or price them, create some, really complex formula so we could create a new instrument to trade. We've kind of seen the results of that. We saw this, subprime crisis where we, built these models and created the AAA credit securities that the financial system needed. At the base layer of the system, you need a AAA, credit asset to keep leveraging on top of the system. And we saw it just completely fall apart in 2008. So we know we're building, we're engineers are trained to think like in the laws of physics that these are like, like honest, discoverable truths of the universe. It's not the way, financial markets and humans, at the end of the day, kind of operate in practice. But I just, had this thought. Remember Isaac Newton, right? The peak quant of all time, right? There's only a few others who hold up to that name, like maybe Gauss, a few others, Einstein, like they're the best, right? He went through this same thing I forget what role he had. Maybe it was like Chancellor of the Exchequer or in England, or maybe he was the head of his university's endowment. I can't remember what it was, but he got roped in massively by, I think it was the South Sea bubble. And
Yep.
at the end of the day, like, he just threw up his arms and was just in complete disgust. He's like, I can calculate like the masses of heavenly bodies and, all of that. But it's like, at the end of the day, like, I cannot calculate or comprehend, the decision making and financial markets of like the behaviors of mankind. So this is, other bubbles, throughout history. It's like kind of history rhymes, not repeats. But there's nothing new under the sun. As much as we're talking about this, the term we used, 5 minutes or 10 minutes ago to call this was like a mass extinction event, in the economy and the knowledge worker or the white collar sector of the economy. It's like I wouldn't call it that, like, just because it invokes too much sense of fear. I think, and panic. This is something, economies like we've been through. There's precedents for this. It's going to be painful. There's going to be band-aids ripped off and people are going to need to adjust, but we'll make it through. And I've heard, Marty, I think you did a podcast with Parker talking about the GFC in 2008. That was a massive rug pull, for people to deal with. Like, just the financial sector got bailed out. The bonuses continued for the industry. Like, no one faced any repercussions for the mistakes made over the pre-financial crisis era or the decades ahead of ill thought out decisions that ultimately led there in policy. But at the end of the day, like, the American working class, whether you're white collar, blue collar, like, you got rug pulled off of that one. So, as much as, we're talking about this is a big technological shift that's underway and accelerating, but, we've survived worse, I think, or hard, like, I don't want to say as bad as it is, like, you can keep digging and hitting rock bottom, but this is just like how the world works. We have to adapt. We have to integrate this into our businesses, into our economy, and that's really the only way to get through this, is to cross that bridge, build the bridge, and get to the other side. The Isaac Newton one.
I appreciate that. Extinction event is it's a bit too alarmist. I agree, Matt. That's actually one thing in 2024. I'm not trying to be doomer. We need white pills. The white pill is we're going to get back to building beautiful things. There will be some turbulence between now and the beautiful things being erected, but as Matt mentioned, this has happened many times throughout history.
And Marty was not kidding. 2024 New Year. TLT, the last trade is an AI podcast.
No, it's an important topic, and there is obviously an intersection with Bitcoin. And obviously, if you're a capital allocator out there thinking about how to place your bets in the financial markets, is going to be a big disruptor to that strategy. Because if you're heavily dependent on commercial real estate cash flows, that may not materialize the way it has in the past moving forward due to how this is going to affect the job market. And with that, I think begin transition to the next topics, but let's just talk about the job market a little bit. We have this chart up here of quits versus hires, and they seem to be hitting a point that would signal that many people are wary about losing their jobs, and they don't feel confident enough to quit and go find another one. So they're not worried about losing their jobs, they're worried about finding another job. They may be stuck in a place that they don't like, but they're not quitting as aggressively as they were in the past. If you quit, you're confident you can go find another job. And then on top of that, hires, both of these quits and hires are below pre-COVID levels. So people are holding steady in their jobs, and then their employers are not hiring as many people. And this is an interesting chart to juxtapose with the jobs data that came out today, the unemployment data that came out today. That's also reaching pre-COVID levels as well. That you had it up there, that one right there. Next one. Nope, other way. Logan's looking for it. There you go. So this is an interesting topic. We're getting two different stories from these two charts. One is that people aren't confident to quit and companies aren't hiring. But here, the unemployment claims data that was released today came in pretty low, back below recession threshold, firmly back below recession threshold. So how are you guys reading the juxtaposition of these two data points? Jesse, we'll throw it to you.
That last one kind of throws me for a loop. I don't know what to make of that. I'm really not sure. I mean, part of what confounds all these employment numbers is sometimes you have you have people with multiple jobs or picking up a second job, and that shows as like good positive employment data, but it's really people struggling and pushed to find a second job just to fit in some extra hours to make some money. And so that is an additional layer in all of this that I don't know what to make of. So I'm not sure about this. I'm curious what Matt has to say on employment data right now.
Yeah, so the BLS numbers, like the big print that markets watch is the monthly NFP print, non-farm payrolls, comes out the first Friday of every month. So we'll get that tomorrow as far as this recording. So we don't have that one yet. That's a massive like lagging indicator. It's a model estimate. They don't actually go through like the BLS and gather W2 data and be like, all right, how many new ads did you have? How many? Like, it's not a precise calculation by any means. Like, the measurement is horribly inaccurate. It's a model, and historically, you can see this in the data. They go through, your initial print. Like, we'll get the December number for NFP job creation on Jan 3rd. You go through two different revisions or updates like over the next ensuing 2 months. So you have 3 months before the December number is locked in. And I use air quotes, even I think this is completely ridiculous. But they're not locked in. Like, you see this, they go back and restate after the fact.
And they've been
it can be like 5 to 10 years later, and restate the let's say drawdowns or job losses in a recession versus the expansion in the business cycle kind of uptick. So the NFP numbers are just like, if you're using them as a speedometer, like, they're terrible. They don't tell you anything like in real time. The continuing claims numbers and new unemployment claims, those are better because like they're consolidated from the state level so you have kind of a more of a bottoms up kind of real time snapshot, and they're reported weekly. They're still noisy, but if you kind of you use a moving average, like, it gives you a better signal from week to week. It could be, there might be noise from the data collection itself. It could also be, let's say Google, like, if you have one big employer in a state, and here in Washington State where I reside, say Boeing was going to do some layoffs, as hey, we see plane deliveries or plane orders slowing down. You might see like a big abnormal jump week to week. So you could actually just get some noise that's actually kind of real activity. Like, it's not measurement error, but it's just coming from like the sample and just idiosyncratic decisions from business to business. But those continuing claims numbers are actually kind of better as a signal to where the economy is, in my opinion, than just watching NFPs and seeing where it comes into month to month. Now, the markets, your equities and bond markets just are hyper attuned to respond to that NFP print as they come in 1, 2, and 3. It's kind of like the beauty contest, if you will, and we're judging people based on what they look like at age 20, as opposed to maybe where they are in life, 30, 40 year olds, whatever, in terms of what they've actually accomplished and how it actually plays out after the fact. So this will create a lot of like noise in markets, but it's not really a reliable signal if you're basing asset pricing on those reports. But financial markets are doing that, so it makes it hard from week to week to really get the picture, or month to month, if you will, over the short term to see what's going on. But as the bigger, longer term revisions come in, they've already, like, you already saw the BLS revised down prior months of last year for job creation we claimed happened, and the first few quarters of the year, those got revised down, and that was after the third and supposedly final print. Once the facts are rewritten, you'll see the economists come out and, put in some new final estimate and lock the number in stone. And it just kind of begs the question, like, what was the real truth? Like, how do you know? Because now you're going back and basing this on a model. Like, do we go back and, collect the W-2s and see the real data? What was the actual number? It just, I think, in my opinion, it just goes to show how hard it is to technocratically manage an economy from a central planning standpoint, from the tops down, based on policy decision, like from an office in Washington D.C. where you're trying to micromanage all of this. And it kind of bundled into that question is like how we manage monetary policy right now. It comes from a board of people sitting around a table at the Eccles building who are going to communicate like one interest rate and manage this whole thing. It's very hard to do.
Yeah, it's all kind of backwards looking too. I mean, jobs numbers can be looking good right now because sentiment is kind of good right now because we've been in 9 months of positive liquidity that has caused markets to surge. And so I kind of have this sneaking suspicion that we're in a bit of like a dead cat bounce sentiment wise right now. Like the rally right now doesn't feel, to me, it doesn't feel real, or sustainable, I should say. Like, are we really going to rip to new highs right now with what's going on with the deficit in particular, and the national debt? And the AI explanation is like, okay, maybe it's real productivity, but this, I don't know. I have this sneaking suspicion that we're going through the same motions that 2007 into 2008 had, with like people saying, "Oh, we had a little gully, and things are recovering, and it's all good," and people actually fall for that sentiment, and you get caught in a bull trap, where you get bullish and sentiment feels fine, right when you shouldn't. That's a little bit doomer on my part, I admit, but I just don't see how the stock markets are going to rip to new highs. But then again, it comes back to liquidity, and if we're in a QE environment because we're printing fresh debt, and deficit spending is the name of the game. Maybe that's what's going on. I don't know. I'm a little perplexed at how stock markets have been so positive.
Well, because it's easy, right? It's just so dislocated from the fundamentals. Matt's going to be able to more eloquently explain it, but from a pure, just like looking at the market, those numbers, I like the first chart because it basically supports what we all have felt. Or if you ask anybody, people are getting laid off and they can't go find jobs, but everything else will say otherwise. And that's like the fundamental when you think about like interest rates rising, like natural cost of capital increases, people spend less, so companies make less, so they have to let people off. These are just like natural order things, but the stock market and the charts and the Fed speak will say otherwise. And I think that's the part that's confounding on your side, Jesse, is like, well, what's happening, because we're at all-time highs, but then there's all this like weirdness around us that doesn't feel good. And I think that's natural, right? Because like we're feeling it and seeing it in the market, but the actual stock market is saying otherwise.
So how to judge where stocks are, like, that's just the Keynesian beauty contest. Like one of the best, like, just to say what Keynes got right, like talking about it's really castles in the sky and trying to come up with valuations. Like as much as people think like, equity markets are the hardest thing to predict. Like a lot of it is based on like sentiment, as opposed to, people who think they're rational, value-driven investors,
it's like Dogecoin.
This thing out. Like it
like
doesn't
Dogecoin
work that way in practice. Yeah. Here's what we like here. Like it's, as far as trying to get your bearings on where this thing is, like dig deeper into the financial system. Like the commodity markets are a great signal. And then I'd say like interest rates, and then we can talk about building a case like the Bitcoin case for what we know on top of that. But I think like going into the base layer, like down to the studs of the financial system, looking at interest rates right now, right? We've been paused, like we've been flat at, Fed funds 5.25 to 5.5 for now 2 quarters, right? Rates, like they're done hiking, like from all intents and purposes. It would take something abnormal versus all the other rate hike cycles we've seen in the rich data sample era, I'd say like post World War II, for another hike to need to be done here. Like something pretty significant would have to take place. But if you're, if
yeah,
go ahead.
Historically, the crisis hits like 10 after they pop hiking, right? So we're still like within that normal time frame of like.
Oh, yeah, totally normal, on schedule. Like this,
Yeah.
I mean, policy might at this point actually be a little bit ahead of the actual business cycle, where they have some room, as opposed to being on their back foot. But I think if you're looking at signals for like rates need to come down, like you're seeing it like with the, like we know with office CRE, like there's a lot of issues there on the rollover from the 2021 vintage of deals that came out. Like, and it makes sense, right? You had the massive fiscal and monetary like impulse, like unseen from Q3 2020 that was trickling into the system. So you had a ton of bad deals made, and so those are going to get rollover and refi. I was listening to the CIO of Muddy Waters last night. He's made a case for a short on Blackstone Mortgage Trust, where I think he said 73% of the loans. Now I don't know if that's loans like by count or loans by principal value in the portfolio, can't finance out of their net operating income either SOFR just alone without the spread, or SOFR plus the spread of their debt financing costs. So that's 73% of their portfolio they've assessed as analysts is gonna be in trouble rolling over on commercial properties like the skyscrapers and Metro America throughout. So like rates are going to need to come down from that angle on bank balance sheets. And you see it in the federal deficit as well, like the interest expense on the chart. You can go to Fred and look that up. Like it's just a vertical line up. Yeah, it is massive. That spike it's taken. So front end rates and the debt refinancing rates, like there's a need from the borrower standpoint. Like it has to come down. It's not sustainable. And if you're looking at the financial markets, like for the capital markets desk, like within the banks, you've got a lot of signals. That's like they're going to come down. As many people are still in the we're higher for longer camp. It's just a matter of time, in my perspective. So you got the 1 year overnight index swap rates, right? These are derivatives contracts, if you will, or swap agreements between counterparties. One leg pays Fed funds overnight over the term of the contract. The other pays a fixed rate. That rate is coming in massively. It's way inside of Fed funds now. It's been plummeting since September, and it's following the 2 year and lower duration or maturity coupon treasury bonds. Like they're coming in. You see the 6-month bill auction, over the last 3 weeks in December has come in about 25 bips, which is like that's the equivalent of one rate cut, right? And then you've seen SOFR turbulence pop up. Like it's not Q3 2019 by any means yet, but you're starting to see SOFR spikes as the system starts moving from an excess cash phase position to like now we have an excess collateral. So it's kind of, as Nick Bhatia described it, he had the best analogy here. We're going to run out of pawn shops who are willing to lend dollars into the system. Like there's too much collateral, not enough dollars available for short-term financing. So, and then on top of that, these quarterly refunding announcements too, where you see where the Treasury issues coupon bonds, so like 2 year, 3 year, 5 year debt, that's spiking up. So the Treasury is reallocating its supply into the 2, 3, 5 year type coupon auctions. And so that's bottomed, which has over the course of, 4 decades kind of signaled the top of a rate hike cycle. And from a borrower standpoint, that makes sense, right? You want to start deploying in as raising more debt there and extending a little bit out as rates start to come in. So as far as equity markets, I have no idea. Like I don't know. Like is Jesse here trying to tell me, is this risky here? Is this double top, whatever? I have no idea. But where you can actually build some sort of foundation and get your bearings, like find a compass, like look to the interest rate markets, and then from there I try to build up my my thesis or positioning, if you will, on what's going to happen off of those things too. So take it from there, but we get into the meat of the topic.
So the Treasury shifting towards debt on the shorter part of the curve, they're basically assuming like, all right, we'll lock in high rates for 2, 3, 5 years with the assumption that rates will come down, and then we can issue longer dated bonds at lower rates.
I mean, it's kind of the opposite. It's like they're showing they're going to borrow more there because they see rates coming down. And that's the signal. It's like we're going to start stepping that up because we need, like, rates need to come down.
Okay.
And then what that's going to do too, I mean, we've seen there's all these treasuries out there with like massive mark-to-market losses. But as rates come in, I have no idea what's going to happen to the long end rates. Like that may stay, relative ballpark. We're at roughly 4% now. We were at like we were hitting 5, right? Back at the end of September. Long end may still stay volatile. Like base case right now, probably don't expect to see the long bond coming into like 1.25, like where it was at the lowest of 2020. I don't think the long end investor at this point like trusts that to like a 30-year debt instrument at 2% from the U.S. Treasury to be able to maintain purchasing power. Like that bridge has been crossed. They've taken too many losses going to that island. They're not going to do it again and bid that thing to 1.25. Like maybe that happens if it's like absolute panic, like we get something worse than COVID at the bottom of this credit cycle. But I think the lessons learned and the pain inflicted, like I don't see it going there again. Now, where front end rates come in, and they base case they do come in. I don't know how far they go, but this whole effect, like it's going to make all of the debt they issued in 2022, 2023 at these higher rates, that's going to kind of pull up their balance sheet capacity. And it's going to kind of pull in a lot. Like, let's say you had a 5-year bond issued in 2020. Now that's a 2025 maturity, a treasury. It was issued at like 0, basically. Took massive losses in 2022 and 2023, but now it's kind of pulling to par. And and then the rates are going to come in as well. So you're going to get more kind of buoying on the bank balance sheets and the financial system balance sheets. So that, expect that, base case to create more capacity for more credit creation. And we have, some continuation. It's going to be weird. We talked about all this kind of strange new stuff in AI and commercial real estate, all of these dynamics that the system has to deal with. But as we go through this cycle, like they're going to have some capacity to try to absorb all of those things that they need to tackle. But I'd say this, like, this is going to be like their menu, like what's on their plate. If you're like a lender or if you're at the U.S. Treasury or, one of the key players in this system, I think your docket of work is like harder than most, if not all of the cycles. Maybe not 2008 was like really hard to deal with. But this one's going to be more of a challenge, I think, in terms of like the lineup of what you have to go through if you're sitting at one of these desks, in this cycle ahead.
Trying to keep the Rube Goldberg machine.
Yeah, absolutely. We'll create another 4-letter acronym and problem solve, yep. Right?
Well, that's another interesting thing to look out for in 2024. That's what they do with BTFP in a few months here.
That's coming up on renewal, and another interesting impact there. Like it's based on this 1-year overnight index swap rate, and that's come in like massively. So you can go and post one of your 15 different government agency bonds that are allowed on the list of collateral that they accept. You can post it, take out a loan now on a rate that's come in a lot, like it's sitting at something like with a 4 handle, and you can go redeploy that into another interest-bearing instrument earning, still you can get 5 somewhere, 6, whatever. But there's just a lot of that. A lot of that BTFP borrowing is just kind of balance sheet arbitrage to pick up free money right now. But I think in the months ahead, like if there are real problems and, what we're talking about, the loans that are underwater, impaired, that need some sort of workout, expect that as we come into mid-March to start to become more of a bigger issue, as that needs attention. Does that continue as some sort of perpetual facility, or do they close it down, whatnot? Do they roll it over? Something that we're going to need to see resolution on.
Yeah, it's interesting when you issue these new 4-letter facilities. it creates these arb plays that were probably unforeseen at the outset that have externalities of their own that you have to deal with on the back end.
Yep.
It's all, I'm just thinking, again, Rube Goldberg machine. That's what it seems like, and they're scrambling to keep it all together. Can they? We will see. They've proven to be able to do it up to this point, but with that in mind, transitioning towards the last couple topics that we have for the episode, we're going to end on the ETF, but before we get to that, stepping stone to that, there was an article out in Bloomberg when it dropped January 4th, today, this morning. City alumni plan Bitcoin securities that don't need SEC approval. So the new offering called Bitcoin depository receipts will be similar to American depository receipts that represent foreign stocks. A startup called Receipts Depository Corporation, very creative, or RDC, said it plans to issue the first Bitcoin depository receipts to qualified global institutional investors in transactions exempt from registration under the Securities Act of 1933, known as BTC-DRs. The offering will give institutions access to Bitcoin securities through U.S. regulated market infrastructure and cleared through the Depository Trust Co., according to a release from the company. So right before an apparent imminent approval of the Bitcoin ETFs, the spot ETFs, a group of City alumni are launching this depository receipts product. I've never heard of these products. How do they work?
So it's a great summary there, Marty. It kind of fills in a few kind of gaps on my map on understanding what this thing was. But I heard a couple key words there: global institutions. So this is going to be U.S. financial institutions selling this product, and I was like, who is the customer here? It says global, so it'd probably be like outside the United States, offshore entities. So if you think about who does this benefit, right? You're getting private keys, the UTXOs. The Bitcoin, it sounds like right now, it's DTCC cleared. The Bitcoin is going to be custodied, where would you call its home? It's going to be U.S. domiciled, is my understanding here. So you get the U.S. capital markets, all the rule of law, everything that benefits investors, and why, besides the economic growth, and we can talk about the bullish case for this country, everything we have going for us, like in the positive column, you get those benefits in terms of capital markets. And the United States has kind of the most well-structured, robust capital markets, I would say, in the world. You have a lot of competition from London, Tokyo, Singapore, et cetera. But this is still where global capital wants to allocate. So I think that's where this product is. And part of the theme as we get into the Bitcoin ETF and what this means, like we can talk about the cash settlement. My read on this is the big capital markets players they're awake, and they want to see the real capital stock. And at this point, maybe they're not all convinced that Bitcoin is the real capital stock. Jesse, was this before we were talking or during the interview? You talked about the shift from kind of a financialized economy into like a capital economy. And I think that's what this is. You want the UTXOs sitting within the borders of your nation state. So I think this, as you talk about the ETF, these 13 ETFs that are looking for the approval window to come through, I think this is part of that theme. Like, this is going to become more and more pressing of a challenge as more and more nation states enter the game. Marty, you've done a great job talking about this, and the follow-ups to El Salvador going first in 2021. What you talked about with Bhutan, what you talked about with Oman, entering the mining game. There been another one like UAE, like there's other nation states who are getting in the
mix now.
Yes. I think they're real. Like, you need the Bitcoin UTXOs inside of your border if you want to actually have a capital base inside of your society's economy.
Jesse, thoughts on this?
I'm unfamiliar with this type of instrument, so I suppose it's like a clever way to have like a fund-like vehicle. But it's unclear to me what the like stipulations are and like redemption policies and who knows what. But yeah, I think Matt is keying in on this. Seems like a play for leveraging all the attractive qualities of having a structure in the U.S., which is beneficial to the U.S. ultimately in this race that people don't seem to know we're in of where is going to be the native home of Bitcoin. Hopefully, it's in the U.S. because that'll be our international advantage, or add to our international advantages for the next century if we manage to achieve that. So thankfully, capital markets are waking up to needing to set up this infrastructure because there's an opportunity for them to make money. But I think it actually has this geopolitical advantages if people earnestly pursue building Bitcoin infrastructure here.
Thanks for tuning in. If you're interested in exploring any of these topics further, or want to learn more about how we can help you secure a new or existing Bitcoin allocation, get in touch with our team at onrampbitcoin.com. We look forward to supporting you on your Bitcoin journey.
Yeah, it seems like, Matt, what you said, people at the institutional level are recognizing, all right, we need exposure to this. I think this product's pretty unique, particularly that you'll be able to track the UTXOs. They'll clear through DTC, which is interesting, an interesting development, which hasn't been brought to the fore until today. And then this tweet came out, which signals that this trend is definitely growing, by Marty Party. Breaking: a pattern is emerging. Other funds registered as securities already trading on the NASDAQ are amending their prospectuses that they can now expose 15 to 50% of their AUM to Bitcoin through the spot Bitcoin ETFs. Here we see Advisors Preferred Trust, filer CIK 00015565505 can now hold 15% AUM in spot Bitcoin through Grayscale GBT. That would be their ETF. The fund may invest up to 50% of its total assets to indirectly gain exposure to Bitcoin through shares of Grayscale Bitcoin Trust, Pro Shares, Bitcoin Strategy ETF, and Bitcoin futures contracts. Don't need to read the 1 quadrillion.
I love this one
there at the end, but this is essentially like the amending of prospectuses to include Bitcoin into the buckets that their mandates allow them to invest in.
Yeah, people have been wondering, like, okay, who cares about the ETF? Like, you can buy Bitcoin yourself. Like, what does it matter? This is why it matters, because the ETFs create a viable vehicle for funds to deploy a portion of their capital into Bitcoin exposure, which results in the ETFs having to buy Bitcoin to back that capital. They have to actually buy the Bitcoin. So this is how I don't know who's running this fund. It could be a small shop, it could be a medium-sized shop, or a big shop. But that sets that's a precursor to what's coming, I think, of every fund saying, oh shit, okay, we can't just have our usual strategy in this era where Bitcoin is monetizing. We need to add in another pillar to our investment strategy and have Bitcoin be part of our allocation. And then they're all going to amend their terms like this and give themselves the flexibility to do that when it's a bear market and Bitcoin has drawn down 70%. Maybe that happens 3 years from now, from a peak of 200,000, and we'll have another drawdown, and then these funds that now have a vehicle, the ETFs, that they can use and have amended their prospectuses, can come in and say, all right, now's the moment we've been waiting for. Let's pile into Bitcoin. And now you're talking about setting the price floor 3 years from now in a bear market because Wall Street has woken up to this thing is going to keep happening. It's beautiful.
Yeah, a couple of weeks ago on the last trade, I can't remember which guest it was, but you were talking about our commodity funds going to allocate in. And it comes down to like a portfolio manager and the investment committee. Someone has to like recommend that decision. Like it has to go through a process. You don't just, on a fund. It's not like hey, I'm going to buy Bitcoin as an individual. You're just like, oh, I'll just open a Coinbase account or whatever, an Unchained account. Let's go with that route, or um, sign on with OnRamp, etc. Make that decision. Like, you've got to go through a process to get this done. But the reason you would do that is because I either want to buy or sell it. Like, I see the market, and at the end of the day, we're all judged as a fund manager, on our portfolio returns against our peers, right? You want to get into the top of the category, so someone sees, whether you would make this decision to allocate 15 to 50% in long, because you see that as, a performance enhancer, if you will, like, to get in front of that. So then you're looking at, stepping in front of, your peer group and hopefully generating excess return. So let's just say we have a Bitcoin bull market that we're in. We've already gone through, I believe, the first wave of it. But as 2024 kind of, proceeds and we work through this, you're going to see the portfolio managers and investment committees who make the right decision rewarded for it, come into the top of their peer group. And, at the end of the day, this is all about capital returns. So, yeah, bullish case. And this is just another capital route pulling in towards ultimately like buying UTXOs.
Well said. Yeah, and that's from you've been in that seat, so the incentives that are at play for every portfolio manager. It's like, how do I get an edge? How do I get that promotion because I've delivered performance? And then here's this low hanging fruit.
Yep. So here's a untold secret, I think, of the fund industry. If you look at the big passive players, BlackRock, Vanguard, there maybe you throw in, like, I don't know, a TIA Crev or like T. Rowe Price or someone in there. There's only like 3 or 4 who are growing as we've shifted, like, the dominant paradigm since, I'd say, like 2000 sometime. Like, you've seen active phasing out, and the shift, the capital shift, like a lot of like 401ks, that constant monthly drift. Like, you just have a recurrent and consistent bid for passive. The active fund managers, Franklin Templeton, are like predominantly active. They're actually not attracting capital inflows, and it's been like since the QE era, since the GFC, it's like the entire 2010s. Their AUM growth has been coming almost entirely from price return. And you think about why, like, QE happens, that pushes financial assets up, and they're not attracting inflows. So they see this problem, like, how do I beat this bid for passive, which is primarily coming into or manifesting through bidding up equities, and was until 2022, bidding down bond yields or bidding up bond prices. That's all started to shift in the last, I'd say, 12 to 18 months or so. But part of this ETF route, I believe, is searching out, if you will, that alpha, that performance, etc. So, we'll see what happens. I think everybody on this panel is bullish on Bitcoin for 2024 and would be making the same decisions if they were in that seat. But this is one of those kind of strategic business decisions that you can make from seat to seat, from a fund like this, that it's very hard to differentiate yourself from your peer group. 15 to 15%, like 50% is a massive allocation. Like, if you're a multi-asset manager and you're spreading between equities, bonds, whatever, I hope it works out for them, like, and they time the trades correctly. If they time it wrong, they're going to bid it, or they're going to buy it. Like, buying at the top of a Bitcoin cycle right in front of that 85% drawdown can be devastating. So, like,
but there
wish
could
them the best.
Yeah, but there's bound to be, there's a bunch of people on Wall Street who've been paying attention to Bitcoin and have at least gone down the rabbit hole enough now to be like, okay, the halving, this increasing scarcity thing, that's happening. Pivot, QE environment seems to also juice Bitcoin, and everybody's expecting that pivot. and there's the ETFs. So like there's all these reasons to front run right now. So I don't like if I was a portfolio manager trying to like better my career, I would probably be willing to bet my career on Bitcoin having a big 18 months. And maybe
But
that's
Matt,
what's going on with
Matt,
a few of them.
Yeah.
Do you think they're that sophisticated, or like I think like the
Some of
concept
them.
Jesse mentioned, like I don't even think
Some,
having like
correct.
we talk about 21 million. I think having in 21 million probably there's 15 to 20%. But the question I was going to ask is how much do you think I could see them looking at MicroStrategy and saying like, oh, that's interesting. More than
They could have
the
already
more-
allocated most of them. It was probably within policy to allocate to a mid cap company like MicroStrategy, or right. You got to catch that. Like time your trade well, get your entry right, be there before you're buying into a blow off top. Otherwise, if you have the right thesis but you're terrible at execution, like the results can be pretty bad from the standpoint of like what can happen. So like I don't want to sound like I'm putting anyone down here. This is not a negative here, but if you look at El Salvador's allocation into Bitcoin, like you got to pat them on the back for making a bold move, taking a big risk, like going out there. But Bukele, like it was 3 weeks ago, I think he published his trade blotter, if you will. He didn't put the actual trades on, but he put the green dots on the line of Bitcoin price where he was increasing his allocation. They were buying the entire way down on the last cycle. They got in on the announcement at Bitcoin Conference 2021, and we're just adding to lots on dips. But you're buying into a market like into the lows, but it's lower lows and lower highs. So what they're doing is like averaging down. Losers average losers. Sorry to be so blunt. I think it's a Paul Tudor Jones saying. And how it actually played out in practice is they were like massively down, and then they didn't increase their position into the bull market or into the bottom of the actual like cup and handle that's forming. They didn't have any buys after November 2022, as there were opportunities to, increase your position size at a lower cost basis in a market that's now moving, like it's trending up. And the net result was like from their holding period of like, let's say June 2021 to December 2023, they got outperformed by T-bills. And so if you do that as a fund manager, and I forget which ticker symbol this fund was, Marty, if you get your timing wrong here, and these guys are starting from an allocation of 0. So all of everything from 15, 17K that we were at the end of last year to where we are now at 40, 45. Yeah, we think there's more bull run ahead, but they're going to be buying into the, let's say, second and third bull waves of a traditional bull market. And so the risk is you're buying into like a blow off top, and then you're going to be down.
Yeah. And a bunch of people will do that.
They will. And you're not in a seat like Nayib Bukele. I think he's got his seat kind of locked up. But if you're one of these portfolio managers and you put up bad performance, like you're going to get pulled off the basketball court or off the field, and like you're going to be out of a job. So you can be right on the right asset class with this massive bull market over 15 years, but because the volatility and the candles are so big, like you can really shoot yourself in the foot here if you don't know what you're doing.
Funny enough, more portfolio managers will get burned by this than will get promoted because of this. The ones that add Bitcoin, the ability to add Bitcoin to their funds, because people are going to buy the top because everybody's new to Bitcoin and everybody learns the hard way how this thing actually works.
And the sharpest,
and then you become wise 6 years later when you have already deployed all your capital.
Yeah, and the best in the business, like, and I'm not that, like Paul Tudor Jones, like he was allocating in like a long time ago. Like he's already front ran like the rest of our peer group in the position. So now you're working into the lower, like the middle of the stack and the bottom of the stack, and this is where mistakes can get made.
Yeah. Well, 12 months from now is when real
12
mistakes
months from now. Yeah. Right.
Well, which begs the question, will these ETFs be approved next week? And if so, how quickly will the capital flow into these assets in an attempt to take advantage of the gains that we think are ahead of us. Not investment advice.
Yeah,
Michael, you've been a
my
bit quiet.
perspective continues to be yes, they'll be approved. I think it's like 95% chance. There's you got to allow some possibility of like a back room. Lawmakers decide this is mission critical to the dollar, and they're going to fight it through some shady last minute measure. But I think, barring that, it goes through next week, and it's a nothing burger for day one. Well, actually, there will be volatility. There'll be like a doji candle, or it'll go up and down on day one. It would be my bet. A lot of volatility, but no real economic substance because no major capital inflows, and so the price of Bitcoin won't sustainably be impacted. I think day one, week one, month one, quarter one. But now that those channels are open for capital to flow into Bitcoin through those avenues, that's very real and will be cumulative over time and will add to the demand side 4 months before the supply side of the equation gets cut in half. New supply issuance gets cut in half in April. And so I think that the impact of the ETFs over the next 18 months will be very large in terms of amplifying price discovery to the upside, because it will increase demand, make it possible for a whole lot of capital to access Bitcoin during the bull market, and so that'll amplify things to the upside. But I think that people need to be prepared for complete disappointment in the first month in terms of like, oh, ETF was approved, it didn't seem to matter at all, but it will matter on a cumulative basis.
Yeah, Matt, would love to hear kind of just what Marty started with and like how big you think this is. Like in reality, there's a lot of takes and, buy the news, sell the news, buy, all the different. I'm curious, like what are your, being in the markets and also being involved in Bitcoin, I feel like you have the best lens of like how big this actually is with all the institutions going to be marketing dollars. Yeah.
Okay. So just first point, like the event, like is it a sell the news? Talk to like a lot of trader types will kind of pitch that, which that's fine. Like as a long-term holder into this allocation, I think you want that, right? We haven't had any retracement in 3 months. Like that's a pretty long period, across Bitcoin's history. And so like, yeah, it'd be great if, the first, let's say 4 weeks, like it announces, it feels like a nothing burger and we get some drawdown. That would be fantastic. I think it's actually needed, a healthy 20% retracement, whatnot, or, hopefully not a 50, but let's just see something like that happen. If it does materialize that way, great. But I think the case study, like that to look at on what this means for opening up a public fund, that's it's the closest thing you can get to a UTXO allocation in an exchange traded fund type of vehicle. So now that's opened up, yeah, this is better than what the markets had before for what is, in all intents and purposes, like an inferior product to actually owning the UTXOs yourself and like holding the keys. And we know that. Everybody on this call, if you're listening to the last trade and you're looking for on-ramp solution for working towards that end game, but you need some hand holding up front too. It's like, all right, you have those type of investors who realize a lot of the benefits of global, censorship resistant, transparent, immutable public ledger money. Like that's what you need. But for a lot of people, they don't realize it. They just need something that's going to be a store of value for their wealth accumulation over their lifetime, whatnot, and it needs to be in their portfolio somehow. So they're going to go the easy route. Whatever it means, like it's just going to happen. Is this big? I think it's actually massive. I don't know. I don't want to put numbers on it. Like you've had, other podcasts where like they put out a price target, like irrelevant. Case study, this Invesco Pro Shares Bitcoin Strategy ETF. It launched in October 2021, basically top ticked the second wave of the last bull cycle. This BITO ticker symbol. If you actually look what's going on there in that adoption, you've seen, all right, it underperforms Bitcoin by, I think it's underperformed by 6%. So you have a fee drag, like it charges 95 bips. So it's a pretty heavy cost, like from an expense ratio standpoint across other fund category, like it's peer group, whatnot. And then you've also got the drag. It's not buy and hold UTXOs where you just park them and, you know, very little overhead. They're buying Bitcoin futures, which you constantly have to roll. And the drag from that is you've got to actually roll over as your future is coming up on maturity. You don't want to actually hold it to cash settlement. Usually what you do is you'll sell out of it and then extend out, and you'll roll it into, let's say, a longer term future. And then you just have to constantly water your garden there. That trade will typically cost you money in terms of drag, just because when you roll in and buy the long, like there's usually a price gap there on like the 12-month that you're rolling into is going to be priced higher than the front end. And then that's even after, like, I think up to like 50% of that fund's allocation is put into T-bills, because you had to post those as collateral to leverage up and buy the futures. So even with T-bill rates at multi-decade highs, like I think it's going back to like 2007, I think, since you know, that type of era, pre-GFC, where you've seen front-end rates hit the levels they are now, they're still underperforming by 6%. So it's an inferior product, if you will. The only thing this BITO fund has going for it is it's an exchange traded liquid vehicle that, like, retail customers with their assets parked in a broker dealer can allocate into a Bitcoin exposure. Like, everybody on this call would probably say, like, yeah, it's kind of Bitcoin. You're referencing the Bitcoin price, but it's not Bitcoin. It's not actual UTXO exposure. All that aside, if you look at share count for this fund through the bear market, it's increased 2x. It's doubled. Like they seeded it with $1 billion. Market cap is up to 1.73 billion. And that's after price return is dragging that down 40%. It's 2x the capital inflows in a bear market. So this ETF is telling you, if you build it, and this is like a terrible product in my opinion, people they're going to allocate in. So then what happens now if instead of futures and 50% treasuries, what happens now if you have that same value prop and now you've got UTXOs in? To believe that it's going to be like a nothing burger over the longer term, like let's say 4 weeks, it plays out as Jesse kind of envisioned there, and it doesn't happen right away, and it actually, the market moves the opposite of the way you'd expect. Like it's a retracement, we're down. I don't think the fundamentals, when you look at the case studies of these other ETFs that are out there, like you're going to get capital allocation in. And the other thing is, like, I can't remember when they launched the short version. So the BITO goes long futures. They launched another fund, BITI, BITI, that is short the futures. So it's like, this is for people who want to short Bitcoin. It did not attract share count creation. Like capital's not flowing into it in a bear market where that one would have actually been up. They I think they actually got it out the gate after most of the drawdowns and Bitcoin was actually done. Like it didn't launch until like end of year last year, roughly, right? So they like Bitcoin's been in a bull, like it's been up trending since. So the like the interest in going short Bitcoin wasn't there. So I think it's pointing at this sign that there is a lot of demand that wants to come in through this channel, that wants to allocate in and be long Bitcoin exposure.
Yeah, I don't think anybody's bullish enough, other than maybe like other than maybe Capsodell, who's back. Yeah, I don't think. I think this is like the chef's kiss on both sides of the market, where you get Fidelity, BlackRock, and everybody under the sun that looks as their Lord and Savior kissing and saying, this is the thing. Everybody's been scared. They've been thought it's for drug dealers and all the things associated with it. And then you get the other chef's kiss, which is, oh, and you buy this in the way that you're used to buying it. You don't have to go and send the wire to Coinbase. You don't have to do all these things. It's like, what else? And if that is to be true, what ends up happening is the thing that we've all talked about is you don't need global adoption. You need 1%, 2%, 3% of market penetration, and the reflexivity of the asset does the rest. And now we're just off to the races. And that's effectively what's going to happen. So I think it's by the news, by the Bitcoin, by everything. Like it only goes one direction.
The fund management industry loves this Like if you look at all the ETFs out there, I don't know how many there are. Like I did some analysis. Let's say there's 2,000. Like if you segment them out by what they actually invest in, like you have equity ETFs, you have fixed income ETFs, then you have like the other. Most of it is equity and fixed income ETFs. Like if you look at the iShares suite, it's like we have LQD corporate bonds, we have an emerging market bonds, we have mortgage backed. They slice and dice the entire pie up, and it's pretty much all saturated for like the segmentation, like fixed income. Like there's a couple of firms who's trying to do it a little bit more granular. They're like, all right, now we'll go corporate. We'll do the slice and dicing based on rating. So this is the AA 1 to 3 year US IG corporate bond, market. Or maybe they'll split it up like there's financials and there's non-financials. Like they're trying to micro segment even more there. But for all intents and purposes, like the equity slices, like large cap, mid cap, small cap, emerging markets, domestic, Europe, like it's all been sliced and diced enough. Like it's pretty much maxed out. There's no and the industry, you need gold plated records, right? You're looking for hits on the wall for, oh yeah, what does it say? 8,000. Like that's worldwide. Yeah. So if you look at like New York Stock Exchange, like the US, like it's some fraction of that. But within equity and fixed income, there's honestly too many. Like we're beyond market saturation in equity and fixed income. So the ability to create more gold records, like you need $1 billion AUM products that are like, that's a really profitable investment product for the financial services industry. Equity and fixed income are tapped out. And then you get into like the alternatives, the multi-assets. Those are hard, right? It's really hard to go into like a distribution pipeline and say like, you need to like come buy our 60/40 fund. Or it's like, there's already a bunch of those too. And they're like commodity funds. You've seen like go to the CBOE or CME and you look at every futures contract. You've seen those put into ETFs now too. You can go get gasoline, like as a retail investor, I need to buy like UGA gasoline futures. I need the oil fund, like the US, like they've already done this. Like it's already just like covered ground. Like it's already saturated. But then the rare bird that stands out in terms of AUM growth, what broke through and is generating a massive amount of revenue, it's been the GBTC. Like this over the counter or this weird, like pink sheet, what started out as, turned into this massive hit product, cash cow. And there is nothing else that looks like it in the data sample from like the economics perspective of like a fund. So what they see here, like there's only 13 asset managers who've gone out of like 50, 100 that have scale and matter. So the penetration of those that see it and want to make this play, it's not even fully kind of baked in that all of them are going for it once, but at this point, like 13 of them are. So they see the economics, that hit product, and this is where there's too much money to be made. You've got the Wall Street players who are now going to be communicating to regulators and Washington D.C. like, I want to see this happen because we could make a lot of money.
Yeah, and that's actually a great call because that's on the institutional level. There's the RIA side as well. When Matt references like tapped out on flows, is like the goal of RIAs is to bring in assets back into their client that they're managing, bringing more and more capital. So they'll bring new funds, new products to the clients. And hey, are you interested? And the idea is not to move over assets from existing positions within the portfolio that they're managing, but to bring net new assets, selling that property, selling whatever that sits outside of the RIA's purview. And now you have this like fund, whether it's the BlackRock ETF, Fidelity's, where you can basically say, hey, now you can pull in net new assets. And then once it starts to be recognized that this thing actually juices your AUM and overall percentage you can bill on, that's a whole other side of liquidity from individual high net worth investors that will get plugged into this. And RIAs haven't been incentivized to do this because there hasn't been any kind of product that they can actually feel good about, let alone, get that chef's kiss again. So yeah, I think there's just no shortage of little pockets of or large pockets of capital that start to feed into this as this thing gets announced.
So are you saying that Suzu is just 2 years too early? The super cycle is upon us?
Wait, Marty, how do you feel about the ETF?
I'll take the contrarian view, and Jesse referenced it. I would not be surprised if the Treasury Department comes out Sunday night with an emergency statement that Bitcoin is a systemic risk to our national security and financial system.
Max Kaiser just tweeted that. Did you see
Did he?
that?
I tweeted it
just,
out last night. It was tongue in
He
cheek.
just tweeted something similar about basically saying ETF is going to be. I don't even know how true this is. This is just what a tweet came up. It was like a delay because of self-custody rules or whatever.
I would not be surprised. I don't think that's going to happen. I think it's like 95% chance that it gets approved. But the mental preparation I'm going through right now is preparing for some disappointment come late Sunday night.
Yeah.
A ninja launch of a Treasury statement.
For the audience, just to it's like Marty and Jesse have been around in this space for a very long time, and what you do when you've been around long, you basically hedge your excitement and all the things. So that is where they're coming from, and I was going to share that, and then Marty saved it for me. He's like, well, I'm just pairing my excitement. You always want to be prepared for the downside, because this happened in basically to everyone here, and probably a lot of people listening. 2021, 2022, we thought this thing was doing, crazy numbers. And I think we were just, like to your point about Susie, I think we were a little early. It was just a little Wall Street said, no, we gotta wipe the floor with you guys and, get our spots set up first before we can let this thing really run. And I think that's what effectively happened the past 18 months. And now we're on the precipice of go time.
Yeah, I think
there may. Oh, go ahead.
I was gonna say, if I'm being I think we'll see go time, but like you mentioned, if you've been around the block.
So wait, which is it? Is it a big deal or not?
I think it's obviously a big deal. I mean, I think like Matt said many times, like it's much easier to get direct exposure to Bitcoin. Maybe it's not easier, but I think it's worthwhile, and that's what you should do.
The longer you've been in Bitcoin, the harder it is to get excited about this. Marty's been around longer than me. He's less excited than I am.
But then you go full circle, like Matt's 10 years, and then you just go insane at the back. Yeah, he's just ready. He's ready for.
Well, that's the goal, is to not go insane, and tempering expectations is a good way to do that, to prevent that insanity from.
But
at the end of the day, go ahead.
After 10 years of every ETF filing being denied, and everybody losing faith that it would ever happen, it really does appear to be a week away now.
Yeah, and a retracement would be nice and healthy for Bitcoin over the long term. I think this executive order or whatever, the Sunday night scenario, at the end of the day, you're looking at a sovereign, balance sheet of Treasury. We need answers to the problem that we're in, the fiscal position of the United States. It's. Hopefully we're not past the Rubicon at this point. We may be. But, where I'm going at here, Treasury needs Wall Street's help. Treasury needs capital markets help at the end of the day to finance itself, to keep society running, to keep the goods and services flowing, to keep the, the country running, if you will. So you're looking for solutions, and ultimately, you can't just... You could try this, but just hammer it down by edict. You're not doing this. But at the end of the day, the economics need to prevail. Capital markets, that's what it's all about. It's resources finding their highest and best use, efficiency, etc. And if you don't follow those signals and where returns happen, ultimately, you're just gonna run into a problem. Continue the direction of where this problem is leading this, where we're just eating our seed corn, going deeper and deeper into debt, and the whole thing won't work. So you got to play along. If you're Washington, D.C., if you're Wall Street, if you're London, whoever, you just, at the end of the day, if this thing works, you're going to need to align and come on board. And I think with the big name, the big players in the industry, you're seeing that. We talked about when I was on in last June, these signals you were saying, the key personnel from Citadel or just big name hedge funds like Brevin Howard setting up the market making desks in US and England, etc., like EDX and Elwood Technologies. So the signs were there that the capital players, they wanted to go here, because at the end of the day, they need growth. Their income statements, their balance sheets, they have to work too. Otherwise, if their balance sheets aren't healthy, Treasury's fiscal position is not going to get any better. So at the end of the day, like everybody's going to respond to incentives like once they come around. And a lot of times we take these veered paths that run straight onto run our heads into a brick wall. It's like, oh, that didn't work. But you gotta find actual solutions that work. So yeah, even if it's a Sunday night edict, whatnot coming down, like over the long term, it's like you just gotta flow with where the water's going, and you gotta fix the problem.
Yeah, and I mean they're smart. Like we talked about it before the show started, the Hong Kong ETF, and close to approval there, and then we see what's happening in the Middle East region and like Dubai, and like the capital is going to flow to Matt's point in a direction, whether it's approved here or somewhere else. So there's game theory behind a lot of this as well, where this is going to get approved.
Yeah, and the incitement for me to send that tweet out to mention it here today with Kim Parker, and I got lunch yesterday. I was asking his opinions, and if you just juxtapose the imminent approval with everything the Treasury, Elizabeth Warren, the bank executives have said over the last few months, like it just doesn't align. And I completely agree. Like if these people were smart, they would let the capital flow to where it wants to go. But I think this administration particularly has proven that they're not too wise, and that's why I put at least a 5% chance on a ninja Treasury statement at some point over the weekend to try to stomp this out. I think it's unlikely, but I do think it's a over zero probability. And just to highlight the numbers that you were alluding to, Matt, I wrote about this last night in the Bent, we should mention, yesterday was January 3rd, 2024, 15th anniversary of the Genesis block being mined. So we're 15 years into Bitcoin. I took the opportunity to put this 15 years into perspective, particularly from the U.S. monetary base and federal debt situation. If you zoom down, Logan, right below this chart, the next chart, like this paragraph here, it's actually pretty crazy if you go down a little bit. If you look at the ratios of like M2 to federal debt over the 15 years that Bitcoin has existed. So in January 2009, the ratio of national debt to the M2 money stock was 1.29. So you had $10.7 trillion in debt to $8.3 trillion in M2. Today, that ratio has ballooned to 1.63, $34 trillion in debt to $20.8 trillion in M2. And as our friend Parker Lewis likes to say, there simply is too much debt and not enough dollars to service that debt. And this is becoming clearer and clearer by the day. Go down. This is like the astonishing set to me. Or go up between the two charts. I think I put it in. Let me see. Sorry. Yeah. So put another way, 68% of the debt that this country has accrued over the last 248 years was added over the last 15 years, or 6% of the country's lifetime. Like that's mind-boggling. It took 233 years to go from 0 to 10 trillion. It's taken 10.7 trillion, taken 15 years to go from 10.7 to 34.1, where we stand today. That's 68% of the debt that the United States has accrued since we declared our independence in 1776 has been accrued in the last 15 years since Bitcoin launched.
I was going to ask about you referenced some of the politicians, and Jamie Dimon came to mind about like some of the comments he made, and then finding out they're an authorized participant. Matt, I'd be curious, like, because this is like a twofer. I know we've gone pretty long. Is explaining or sharing what do you think is going on with like a Jamie Dimon and saying, like, talking out two sides of his mouth effectively, but then also kind of going into the minutia of like the cash creates and like where the authorized participants sit and how these ETFs are going to like work in practice, because I think that's been a big topic. And I think all of the ETFs that are going to be approved are all cash creates or redeems. And just walking through that, I think would be helpful for us, but also the listeners.
Matt is still here. He's just checking a text message.
Oh, okay.
We lost Jesse. We'll use
his phone died.
We'll use this opportunity. No, because he's still on the stream.
Oh, okay.
We'll use this opportunity to let you guys know that Jesse just Irish exited on us. He had to leave to take on other obligations, but we're still here, and Matt is back.
Am I back? Good. Yeah, no, a call just came in. I had to red button it, but then, yeah, the app it was hard to get audio back on. Can you guys hear me?
Yes,
Yep.
sir.
Okay. So yeah, Chase coming in as an authorized participant. There's not all that much business impact there. I mean, it's just like the ability to create or like increase or decrease share count on the ledger, and a lot of parties can do that. What that effectively means is like how the structure of the ETF actually plays out. So you have the share count, right? And the way that like the retail investor or like, you know, the brokerage customers will allocate into shares, they'll just buy and sell through their brokerage. One of the key things like that's going to differentiate the 13 ETFs is going to be liquidity. Like they need to get their bid-ask spreads down to a penny, and that'll be an early signal on which of these 13 firms are winning, right? Because they're not all going to be winners, like in an industry or a kind of like niche where they're not competing on anything other than expense ratio and, you know, maybe liquidity. You know, under the hood, you could be looking at as like which ones are rehypothecating, which ones are not, but that won't be apparent to investors on day one. They probably won't be thinking about that. It'll just be those two up and front features, if you will. AUM too. Like you won't allocate into a fund that's only got 10 million, 50 million, 100 million in it. One with like on its market cap. That's where like size begets more size. So I'd say those three dynamics will be like the primary. If you're going to allocate in, that'll be your choice on who you buy from. Or it might be you also have an existing relationship with, like let's say BlackRock, your pension plan. You like BlackRock is kind of your consultant or advisor on your multi-asset allocation. If they come in and recommend to your investment committee or your board, it's like, hey, buy our IBIT ETF, right? For your Bitcoin allocation, that will steer in clients from there. But how do you get there, right, to outcompete the other 12 offerings? Or, you know, it could be more as other firms realize it's like, oh, hey, BlackRock's having success. If I'm Vanguard, you know, I can claim, you know, and stick by my kind of logic on my masthead that like we're value investors, or our thesis is to just own the market 100 play and that's it. We're not going to go in. Well, there's going to be business that you're losing and giving up because of that. So it will come into play. But as far as like the cash creates go, they're all going to be cash settled for create redeems. There's not going to be any in-kind redemptions. The prospectus for BlackRock now reads, it says, we may, if they can obtain regulatory approval, add on in-kind creation redemptions in the future, but that's off the table for now. So what does that actually like amount to at the end of the day? Like if you had in-kind cash creates and you're an authorized participant, what you could do is trade Bitcoin for shares, and that opens up another arbitrage route for you as a capital markets desk. What do I mean by that? Let's say the share price of IBIT shares or whatever ETF is above the NAV. Like you're still going to be able to arbitrage that out. Like you see that with every ETF. These like the market makers and APs, they're always trying to whittle away the arbitrage between the underlying assets and like let's say the number like the UTXO count per share and then the market price of that. Like they will still engage in those shares or in that level of arbitrage, but there won't be the ability. Like if you're Chase, you're involved with markets across the world, like every asset class, not just equity, fixed income. Like at this point, you're in commodities markets. Like you've seen headlines in 2023 about how JP Morgan got spoofed on a nickel delivery in I think it was Europe, and there's just like rocks in the on the pallets or packed in the pallets on the delivery that were supposed on physical settle that were supposed to be nickel, but it turns out like yeah, you got hoodwinked. But in that landscape, your capital markets desk can try to arbitrage. Like if you think about it through Bitcoin, what is the cheapest way to acquire a UTXO? Like traditionally so far, it's been you use stranded energy, right? You set up a mining operation, you mine Bitcoin, and you find the lowest cost to produce, you know, one Bitcoin, whatnot. and you sell that in the market, and that's your profit margin as a producer. Now, if you had in-kind creation redemption, what you could do is set up a series of arbitrage trades, like down to verticalizing, like down to the studs, the energy resource and the ASICs and the foreign exchange, cross-border capital, where you could arbitrage like all the way down the value chain and get all of the profit from, basically zero up to spot price of UTXOs. The reason to, like, the demand coming in, the inflows, like the bid for these Bitcoin ETFs, that enables that as well. So the more capital you get on the demand side coming in through that route, the better off you'll be in terms of being able to capture as much of that spread between your ability to produce the raw commodity and that price you can sell it at. That's not going to happen right now. Like, that's not getting approved. And the reason is, like, the regulators see, like, that whole market is not ready, right? Like, when you look at energy, cross-border commodity trade, like, it's still, as much as capital markets have kind of progressed over this 40-year bull market era in our lifetimes, like, we're in the most financialized economy that's probably ever existed. There's still a lot of just cut corners, booby traps that can get you in the commodities trade, those type of trades that even, materialize in, like, the biggest financial institution in the world, JP Morgan Chase, can get hoodwinked on a commodity trade. So it's like, it's clearly not there where we can, where regulators see that they can put that whole kind of, or open up that whole mechanism where you're not just going to get some sort of just, I don't know what else to call it, like, other than, like, just breakdown, malfeasance, whatnot. So they kind of realize they can't police it and they can't ensure integrity, like, if they open up that route. So at this point, what's the next best thing? Like, okay, we're just going to do the settlement, cash settlement. What that actually kind of boils down to, the APs are just, they're cash processors. They don't actually ever touch Bitcoin, right? They're just taking in shares, and they'll either kind of put them to the portfolio manager, or it's actually like the fund administrator, or like they call it the transfer agent, who will adjust the share count, and they're just settling cash. Where it actually comes into play, what it actually means is the portfolio manager behind these funds is the only ones who's going to be making the actual Bitcoin to dollar transactions. And it means, like, basically they're not an active player. They're not timing price. They can't go out and just post bids and wait for the liquidity to come to them. Can't just post offers, wait for that liquidity to come that way, both ways. They've got to, every time they buy and sell, they're going to have to cross the bid ask. Like, they're going to have to hit the bids, lift the offers. They're just completely passive players. So where the value actually flows in this case is to the spot market makers in UTXOs and dollars. And that's where these headlines we were talking about last June with all of these key personnel, it's like, wow, they opened up these market making desks in Bitcoin, and they're also altcoining, or, I don't want to use 4-letter words and call them what they are. They're also going to do that, but the Bitcoin USD market is where the interest is, and tying that down. And while all of the headlines, like, everybody was following ETFs, I think we were missing the kind of the forest for the trees on what was really going on. The capital markets desks were moving into market making on Bitcoin, UTXOs, and dollars. So that's the big deal. I think the elephant in the room is, I mean, it's ultimately good. Like, you're going to have more liquidity in the Bitcoin markets, more capital flowing in, but it's just, I don't know, it's changing. Like, you're getting the professionals involved in market making and Bitcoin, which is, if you think about it, this is where it needed to go. Like, we had, you can say Binance, CZ, like, they were, Marty on RHR, you and Matt have talked about, like, CZ's kind of a different breed than the FTI. Like, he's been a Bitcoiner, or he's been in the space longer, still made a lot of, like, short-term decisions to go after, the altcoins, all that dumping on retail. But you saw the real kind of fly-by-nights come in, I'd say, like between the 2017 cycle and the 2020 cycle, where you saw like FTX just show up out of nowhere. That's all been pulled away, I think, and you've seen like the big players now are going to enter the market making space. So I think that's the key tie-in, I think, of what's really happened, or like the main crux of it that I think a lot of us are missing. It's the maturation, if you will, or the absorption into legacy capital markets of the Bitcoin market making. And then also, I think the other element, we talked about this before, is like, where do the Bitcoin actually domicile and find their home? And I think the nation states now have realized, we know at least some, El Salvador, Bhutan, Oman, etc., have disclosed publicly and made decisions that they're acquiring and holding Bitcoin on their balance sheets. But this is a play, I believe, without saying it out loud, that U.S. capital markets are realizing the importance of having those UTXOs, the Bitcoin, custodied and domiciled within the United States. So because it's cash settled, the Bitcoin can't be arbitraged. Like, you cannot construct the trades to arbitrage, what we talked about. If you wanted to let Bitcoin create redeems come in kind, where those Bitcoin could just leave and leave the country if they wanted to. Now they're contained. They're domiciled. They're going to be custodied, I believe, with Coinbase. I think, if I have that right, correct me if I'm wrong. And then from there, it's kind of a roach motel is the way this is set up. The Bitcoin aren't going to leave. When there's a sell order, dollars go out the door. The actual Bitcoin that the portfolio manager at BlackRock or Franklin Templeton or Invesco, whoever, they're going to sell the Bitcoin into the spot market, and then it's going to live on the balance sheets of whoever their counterparties are, which is also U.S. entities. So it really is a kind of compartmentalization of the capital stock, in my opinion. And I think the kind of elephant in the room, the last time we went through this, 1970s, it was all about where's the gold going to go. Like, we shut down Bretton Woods in 1971 because too much gold was leaving the country. We closed the exit doors. It's the same thing in the Great Depression. 1933, he had Executive Order 6102. Private individuals can't hold gold. It's going to be all kind of mapped in. The Army's going to defend it at Fort Knox. I think we're realizing as we go through these big transitions in the global monetary system, the signal you're looking for is the nation states are going to be looking to ensure that the capital doesn't flee their country. And first thing is shut the barn door and make sure, more of your cows and horses don't get out. And I think the next move, if you want to do this well, is to attract more capital in. So this idea that you come in and shoot yourself in the foot and treasury issues in order, like, you can't do this. This is a threat to this is the threat to the fiscal position of the United States. I think it's probably the exact opposite. If you do not attract capital or you can contain it, but you don't want to make it too heavy-handed, because if you make it clear that you're implementing capital controls, that's a sign. It's going to be taken as a dog whistle. You're going to be like, I need to get this out. I need to get my gold out of Nazi Germany. I need to get my gold out of Japan, whatnot. As an individual is what you'd probably be thinking in those countries. The way to do it well, if you're thinking for the long term, I think you want your nation state, your society to prosper, is you got to attract it in. So I think this is a key moment to get it right. We'll see with the decisions made ahead. But yeah, that's just a little bit of thoughts on the cash settlement. I think it is a big deal. There's reasoning behind it, and it's big things are at play.
That was a lot of thoughts, wasn't it? Well, now that's made me think. We're thinking these people are playing 4D chess. Maybe all the posturing by the Treasury and Elizabeth Warren and Jamie Dimon has been a misdirection play towards international markets. Like, no, we don't want to do it. So
to say they're playing 4D chess and you're just in a massive, you've gotten yourself in a really bad fiscal decisions with especially the decisions made after the Like the 1998 kind of global Southeast Asian debt crisis is where this kicked off. Like we've just been putting ourselves more and more in a bad position ever since. You don't give up your queen on like move 4 or like just like trade like rooks for pawns, and like everybody's doing that. But like to claim like you've been playing the long play all along, it's like I don't know. Like if I'm not a chess grandmaster or anything. It's like it doesn't make sense to make those moves and put yourself in this kind of position, like this far behind, if you will, in the debt situation. If you were really trying to play well, like 4D chess analogy.
Yeah, the thing that came to mind when Matt was talking about it's like basically geopolitical capital silos and the Hong Kong reversal. Remember, like they took a hard stance on the crypto and the banks last year, and then that like randomly kind of pivoted post ETF, like when this chatter started. You could, if this like thesis plays out, you could start seeing these like markets, whether it's India, Asia Pacific, Hong Kong. We're seeing it going on in the Middle East, where you start developing these like financial products, and you start to bring in the capital flows, specifically Bitcoin, into these vehicles versus other offshore vehicles.
But just pause and just reflect right now, like Marty, your 15-year piece. Isn't it just mind-boggling that this is where we are right now? Like this thing that started with one guy and start like 2 nodes with Hal Finney, and it's like it's gone here. It's like this. It tells you something like, people are aligning around it, or the biggest entities in the world, our nation states, are now kind of having to address and come to terms with aligning around this consensus mechanism is what's actually going on.
It's beautiful.
It's pretty crazy.
And doesn't it make it feel like 21 million really isn't a large number? You know,
no.
It's just
the number is arbitrary. It could have been 2. Like we'd fractional, and we like it'd be sliced up, and we'd call the unit of account like sats or whatever. But yeah, you just got to pick a number.
There's only going to be 21 million freaks. If you're listening out there, it's going to be a lot of people trying to get their slice of the 21 million after next week. We're 2 hours in now. This has been incredible.
All right.
I like this new format. Michael, are you pleased with the format?
I love it. I think there's a lot of things that Bitcoin will touch, and individuals want to hear how it touches it. Like the AI thing, I think was great. I think we probably just gotta I don't think we or individuals have 2.5 hours to spend on pods with all the ones coming out. So we'll get better on the timing. But I love being able to talk about some of the other stuff that tie into Bitcoin.
Yeah, we'll have to work on the timing. Jesse's a very busy man. He only has an hour and a half for us each
Jesse,
week.
Irish exit. Yeah.
He ghosted us.
Yep.
He ghosted us. Before we ghost the audience, gentlemen, any parting thoughts, parting notes, things we didn't cover that you think we should touch on before we wrap up?
Matt, do you feel comfortable? I don't want to do the price, but like, give me something. Give us something on like how big this cycle goes. Like how should we think about it as compared to previous?
I don't want you to mention price, but like, how high do you think it goes?
Maybe it's less about price. It's more about just like adoption, right? We had, Sailor last year. We had El Salvador. Like, where do we see this entrench into like, global like culture, all the things in this next wave?
I don't know. I haven't really put too much time into coming up with a price target. I'm more just I try to watch flows and kind of the waves, if you will. Like it's more than it is today, obviously, top of cycle. I think the last one, interestingly, people talk about the top of the last cycle. This is a weird one because there was the double top element. The first peak it was like right as that China ban was coming, right? Which was, Marty, you might know timelines, but June of 21, that was the first peak. And that was really what you would call like the technical peak of the cycle. And from there, we were in, my opinion, we were in the big retrace. Now, you got the rally from, I forget how low it dipped in that intermediate from like 60K the first time, and then it hit it again. Like it went down to maybe like 40, 30, I don't know, somewhere in there. But that next rally from like 30 to 40K back up to like a new all-time high at 65K, my perspective on like what was actually going on in the capital flows of market, et cetera. Two things. One, the money printing and the fiscal stimulus was so strong in COVID, like the embers just wouldn't burn out on that process. Like we're still dealing with that. So that gave a massive, like a continued tailwind. But then I think you're also looking for, in terms of that, like the rally, right? The bear market rally, which in my opinion was that second wave of the double top. That really the top tick of that market was the launch of that BITO ETF product, and then capital flowed in. We talk about how it's an inferior vehicle, it's an inferior product, but capital flowed in. Share counts up 2x over the 2 years or so it's existed. That tells you, it tells me and my read on this, like this underlying bull market, like that only happens where you have that bear market rally that can overshoot that top if the underlying bull market is like extremely strong. So I think that's what I look to for signal, and it's pretty dang obvious. Like the longer you've been here paying attention, like there's something going on in Bitcoin. It seems to be there's a pretty massive bull market going on over the last 15 years. You know, what we've seen so far, every cycle peak is considerably higher than the previous cycle top. So no idea where we get to in the blow off or in the final phase. I don't know how this bull market cycle ends. Like we won't know it until it materializes. Like no one saw the China ban coming like in real time unless you had some sort of like inside information and you knew they were working on implementing it. Like the market was picking up those signals, but you didn't know what the headline was that would chop it off, right? Same thing with the ETF launch. You might have had a sense that product was coming out, the filings. We weren't watching it to the same degree that the Twitterati or whatever, the X audience is just, they're just on these ETF launches like there's nothing else going. Like they're putting so much attention into that, but it wasn't that way for the BITO ETF when it launched. So like that whole point, like the underlying sentiment of how people are going to behave, I have no idea what they drive price to this next cycle, but like the actual waves, like underneath this thing, like there is a lot of energy behind this thing. So who knows like where it goes to. And I think if you're in it for the long trade, like the long term, and you're using this as your store of value, it doesn't so much matter. Like don't let the highs push you to like past your emotional peak, or don't let the lows stop you out. Parting thoughts.
Tsunami. That's what I heard.
Hey, props. I know Japan had that earthquake. It's no joking matter. Those are dangerous.
Yes, I mean I was trying to throw a little joke out there.
Hearts out to Japan dealing with that that crisis.
Japan, Indonesia.
Yeah.
Not trying to be not trying to denigrate the impact that actual tsunamis had.
It's not a good thing.
Theoretical.
But you gotta be careful. You gotta be careful out there.
With that, Michael, anything?
No, it's awesome, Matt. I appreciate you jumping on. I think your analysis is great. I think we probably get muted volatility to the downside based on long-term holders and retirement accounts, where it's not like people just selling out. That'd be a quasi prediction versus the crazy 80% retraces we've seen previously.
Yeah.
Yeah, and if the boomers' retirement accounts allocate to Bitcoin, then they unfortunately pass it along to their millennial kids, or millennial kids are like, all right, double down on this, buy some more of this.
Here's a great point I heard a non-Bitcoiner make on a podcast last night. Talked about sentiment. Like the last time Bitcoin was at 40K, people were a billion. And this was like on the way down, like Bitcoin conference 2022. We didn't realize the depths of what was ahead of us. Like all of these lending failures, so Celsius, BlockFi, FTX, etc. And now that Bitcoin's back at 40K, but sentiment's not where it was. Like I know within this call, like these individuals, and then you talk to Bitcoiners at the conferences, like they're incredibly high sentiment. Like their convictions were just like steeled with the banking crisis, or like what happened with SVB, whatnot, and like just reinforced all of their core convictions. But if you just talk to the general public right now, Bitcoin's not at an all-time high. There's much lower sentiment than there was the last time we were at 40K. So I think that tells you, like, just understanding where you're at in the big picture of this current cycle, where we are, and no idea how this one ends. They're all kind of different, but tells you, keep riding the trade.
Yeah, I think the flows, not to go, but the flows, Barney, it triggered me. Like, we've been looking at this for so long. I think we forget that, like, sending money into Bitcoin is like sending into a casino from a market perspective. Like, you have to sell from one place, you have to get the cash, and then you're moving it to Coinbase or a Kraken. Like, what is a Coinbase or a Kraken to the general audience? Like, you might as well be sending it to Bovada or wherever to gamble. And this idea that, like, if somebody even wanted to trade it requires a lot of work. It's like, let me just wait till the ETF from a retail perspective, and then from an institutional perspective, they can't do it either way. So, like, the idea of that this thing launches and then it just kind of like hangs out there for a little bit, what we were talking about earlier, I just don't see it, because it just feels like it's the product that needs to be in the market for the flow to actually start to move.
That's a great point, actually. Glad you raised it, because, like, a lot of the firms who've popped up who have been Bitcoin focused, Bitcoin only, like, the Unchains of the world, whatnot, like, they were not going the altcoin route and shilling Doge to your email list. Like, you were giving up money. Like, you were choosing to forego, like, the marshmallow on the table so you could get more later. But I think, just opinion here, but, like, that long-term decision making over the last 5-7 years, like the 55, 6-year-olds, like the broader population, as you work your way up that S curve of adoption, you're trying to break through more than the, let's say, 1 to 3% of people who've adopted Bitcoin at this point. If you want to get the next 10, 20, I'm sorry, like my mom's not going to go. Like, she doesn't want to view this as a casino. She doesn't go to casinos. Like, that's not what works for that person. And so, the financial institutions, the service providers like that, who are just focused on Bitcoin only, I think that becomes an asset in this, as opposed to foregoing the marshmallow, in the last cycle and the cycle basically since Ethereum, showed up. It's been, I guess you had Litecoin even before that and stuff like that, but there was always that element of, as Michael mentioned, I'm going to sell my holdings and whatever I was storing value in before, and I'm going to move that to the casino. Like, if you're looking for broader adoption, like, the people aren't going to do that. So I think that's, if we're making hot takes for 2024, I think it's when the firms and entities who successfully pass the marshmallow test and prior cycles, I think this cycle ahead is where they can get rewarded for that.
That's the thesis at OnRamp. Our thesis at 1031 TFTC. Don't eat the marshmallow. Wait for the mountain of marshmallows.
It's poison. It's poison.
It's poison.
Yeah.
Gentlemen, it's been a pleasure.
All ribeyes here. That's it.
It's been a pleasure. This is a great way to start the year. I guess we may have some closure on whether or not the ETFs are approved by the next time we record. So next week should be interesting too. Come back and join us at the last trade.
Thanks, guys.
See ya.